Welcome to the Owner's Playbook, the podcast for visionary business owners who are building something bigger than themselves. I'm Carol Dewey, founder of Claris Advisory Partners and creator of the Navigator System. Each week, we help business owners increase company value, reduce unnecessary risk, create more personal freedom, and ultimately build a business that serves their life, not consumes it. Today, we're talking about a business partner that most owners never invited into the room. A partner who contributes nothing to sales, nothing to operations, nothing to leadership, nothing to innovation, yet often receives 30, 40, or even 50% of the profits generated by your hard work. Today's episode is called The Silent Business Partner Taking 30 to 50% of Your Profits. And yes, we're talking about taxes, but not in the way most people think about taxes. This isn't going to be an episode about filling out tax forms or understanding IRS regulations. This is a conversation about wealth. Because after years of working with successful business owners, I've discovered something fascinating. Most owners know how to make money, far fewer know how to keep it. And that's what ultimately determines your financial future. So let's dive in. Have you ever experienced a year where revenue increased, profits increased, customers increased, and the business appeared to be thriving? From outside, everyone thinks you're crushing it. Yet somehow your financial life doesn't feel dramatically different. Your tax bill increased, your responsibilities increased, your stress increased, your payroll increased. The complexity of running the business or the company increased. And despite all of your success, it doesn't necessarily feel like you're moving closer to freedom. In fact, many business owners privately tell me they feel more trapped than ever. That's the part nobody talks about. The public sees success. The owner often feels pressure. The public sees growth. The owner sees responsibility. The public sees wealth, the owner sees risk. And when you start pulling back the layers, one of the biggest reasons is because business owners spend years focusing on earning money while giving very little attention to keeping it. That's where the silent business partner enters the picture. One of the most common patterns I see among successful entrepreneurs is what I call the success trap. In the early years, growth solves problems. More revenue means more opportunity, more clients mean more momentum, more profit creates excitement, but eventually something changes. The business gets larger, the responsibilities multiply, the owner becomes increasingly indispensable. The tax bills get bigger, the stakes get higher. Suddenly, you're generating more income than you ever imagined, but your lifestyle and freedom aren't keeping pace. You begin asking questions like, why am I working this hard? When does this get easier? Why does it feel like everyone else is benefiting from my success? Many owners have unknowingly created a high-income job rather than a valuable business. The company depends on them. The family depends on them. The employees depend on them. And every year, a significant portion of the profits disappear before they ever reach the owner's balance sheet. The problem isn't that you're making too little. The problem may be that too much is leaking away. Imagine owning a building with a hidden leak in the roof. Not enough water to create an emergency. Not enough to force immediate action. Just a small leak, day after day, month after month, year after year. Eventually, the damage becomes substantial. That's how taxes often affect business owners. Not because taxes are inherently bad. Taxes are simply part of operating a successful business. The issue is efficiency. Most owners monitor revenue obsessively. They monitor expenses carefully. They review profit margins, yet surprisingly few monitor tax efficiency with the same intensity. And over a lifetime, that hidden leak can cost hundreds of thousands or even millions of dollars. One of the biggest misconceptions in business is the belief that higher revenue automatically creates wealth. It doesn't. We've all met business owners generating millions in annual revenue who are still financially stressed. We've met owners with large businesses who can't step away for just 2 weeks. We've met owners who look wealthy but remain completely dependent on the next quarter's performance. Revenue is not wealth. Revenue is activity. Profit is better. But even profit doesn't tell the whole story. The question that really matters is, what ultimately reaches your family's balance sheet? What do you actually keep? Because what you keep determines your future options, and options are what wealth is really about. One of the concepts we're going to talk about frequently on this show is what I call the owner's wealth triangle. The 3 sides are business value, tax efficiency, and personal freedom. Most business owners spend nearly all of their energy focused on business value. That's understandable. The business is their baby. The business funds everything else. The business creates opportunities. But here's the problem. If you ignore tax efficiency, much of the value you're creating disappears. And if you ignore personal freedom, you can spend decades building a company that owns you instead of serving you. All 3 sides matter. Business value creates opportunity. Tax efficiency preserves opportunity. Personal freedom is the reason we wanted the opportunity in the first place. When one side is weak, the entire structure becomes unstable. Most people assume taxes are the biggest threat to their wealth. They're certainly one of them, but they're not the only one. In my experience, business owners typically lose wealth in 4 ways. First is excessive taxation. Second, unnecessary risk. Third, poor succession planning. And fourth is just lack of liquidity. Taxes are obvious. Risk often isn't. A lawsuit, a disability, a key employee leaving, an economic downturn, all can dramatically impact wealth. Then there's succession planning. Many owners spend decades building a company, but never create a clear transition strategy. And finally, liquidity. I've met business owners worth several $1 million on paper who struggle to access meaningful cash flow outside their company. They are business rich and freedom poor. All 4 of these issues interact with each other, which is why integrated planning matters so much. Let me share a pattern I've seen repeatedly throughout my career. A business owner comes into our office. They're successful. Their company may be worth several $1 million. They've worked incredibly hard to get there. They've sacrificed. They've taken risks. They've overcome challenges. And they're proud of what they've built, as they should be. But once we start asking questions, a different picture often emerges. Most of their wealth is trapped inside the business. Their retirement assets are smaller than expected. Their tax planning has been largely reactive. Their estate documents haven't been updated in years. And they assume selling the company will solve everything. Unfortunately, that's not always true, because a business worth $5 million is not the same thing as receiving $5 million. Transaction costs matter. Taxes matter. Deal structure matters, and timing matters. What ultimately lands in your family's hands can be dramatically different from the headline number. That's why planning years before an exit matters, not months, years. The biggest financial event of your life deserves more attention than the biggest vacation of your life. Yet many owners do the exact opposite. Many business owners think about taxes annually. The IRS thinks about taxes transactionally. And one transaction often matters more than all the others combined: the eventual sale, transfer, or succession of your business. For many of these owners, this represents decades of effort condensed into one financial event. Yet surprisingly, few begin planning for it early enough. Instead, they wait until the opportunity arrives, and by then, many options have disappeared. The most successful exits don't start when a buyer appears. They start years before the business ever goes to market. That's where the tax strategy becomes wealth strategy. I believe one of the greatest misconceptions in business ownership is the belief that wealth automatically creates freedom. It doesn't. I've met wealthy people who are completely trapped, and I've met people with far less money who enjoy tremendous freedom. The difference isn't always the size of the bank account. The difference is control. Can you step away? Can your business function without you? Can you survive unexpected setbacks? Can you spend time with family without constantly checking your phone? Can you choose to retire? Can you say no? Can you design your life around your priorities instead of your obligations? That's freedom. The purpose of building wealth isn't simply accumulation. It's creating options. And every unnecessary dollar lost to taxes is one less dollar available to create those options. The most successful business owners I've worked with don't wait until the finish line. They understand that business strategy, tax strategy, estate planning, investment planning, and risk management should all work together. They don't view taxes as an annual event. They view taxes as a lifetime consideration. They don't wait until something happens. They prepare before it happens. And because of that, they often create dramatically different outcomes. Not because they worked harder, not because they got lucky, but because they were intentional. If you're listening today, here are 3 simple actions you can take immediately. First, determine your true effective tax rate. Not what you think it is, what it actually is. Second, ask your advisory team what tax planning opportunities should be explored over the next 3 years. Not next April, the next 3 years. Third, determine how much of your net worth exists outside of your business. That answer alone can reveal a tremendous amount about your financial independence. Because if most of your wealth remains trapped inside the company, your future may be more dependent on a successful exit than you realize. The silent business partner isn't going away. Taxes will always be part of the equation. The goal isn't avoiding taxes. The goal is avoiding unnecessary taxes. There's a difference. The business owners who understand that distinction often create dramatically different outcomes for themselves, their families, and their future. But at the end of the day, success isn't measured solely by what you build. It's measured by what you're able to keep, what you're able to enjoy, and what you're ultimately able to pass on. Business value creates opportunity. The tax efficiency preserves opportunity. Personal freedom is the ultimate objective. And that's why the owner's triangle, wealth triangle, matters. Thank you for joining me for another episode of The Owner's Playbook. I'm Carol Dewey, founder of Claris Advisory Partners and creator of the Navigator System. If today's episode challenged the way you think about taxes, wealth, and business ownership, I'd encourage you to subscribe and share it with another business owner. Until next time, keep building with purpose, protect what you've created, and always play the long game. This is The Owner's Playbook. We'll see you on the next